Welcome back to our first video lecture. We're going to cover chapter 10, and we're going to spend some time talking about analyzing the historical performance of the firm and what that looks like. There's going to be a couple of things that we'll point out, things that we need to be aware of, things that details that crop up, and things that can make our life more difficult in this part of the DCF process that should be one of the more straightforward parts of the whole thing. So to start, we'll break this down into three sections. First, we'll talk about ways to further analyze return on invested capital, the ways that we can compare two different firms and how they stack up. Then we'll talk about how to further analyze revenue growth. This is super important because revenue growth is going to be the main fixture of our forecasts about the future. So if we get something wrong with revenue growth, we're going to get a lot of things wrong farther down the line. And then we'll talk about evaluating the company's credit health, financial performance in the past, and see how that might affect our forecasts about the future. Remember, all of this is with an eye on the future predictions that we're going to make for the firm, right? So we're looking at the historical performance. We're trying to understand why the firm's return on invested capital is what it is. Could it be any different? Could it be better? We're going to do that by comparing to other firms that do the same thing. And most of this chapter will, in most of the class, we talk about FedEx and UPS. So we're comparing UPS to FedEx or vice versa and saying these two companies are similar but different. How could they be changed to make themselves better? Is that possible based on the comparison firm? So we'll start with ROIC. And of course, we've looked at ROIC a lot, so we know what that's all about. ROIC is NOPLAT divided by invested capital. And we've looked at and solved for return on invested capital for both FedEx and UPS in a previous chapter. Now we can see them graphed out over the historical 10-year period that we tend to look at when we're doing a DCF analysis, 2004 to 2014. And what we see, and what's immediately striking from the graph, is that the ROIC for UPS is significantly higher at all time points during this 10-year period than FedEx's ROIC. So we see UPS has an average of probably above 15, maybe 16% return on invested capital, which is incredible, versus FedEx, which has a return on invested capital probably average here over the 10-year period of about 7%. So UPS is beating FedEx in terms of return on invested capital by almost 10% throughout the whole period. And that's a pretty striking difference for two firms that we would expect to be pretty similar, that we would expect to be pretty close together. I mean, these are maybe the only two competitors in their space, but they're both pretty dominant large competitors. It certainly wouldn't seem to me on the face of it, if I had never looked at this before, that we should see such a striking difference. And what we have to do either way, whether we're working for UPS or whether we're working for FedEx, or whether we're interested in investing in one or the other, what we need to do is try to understand what's driving this difference. Right? Why would I invest in FedEx if I look at its closest competitor outperforming it over a decade, over the past decade? And likewise, maybe we're working at FedEx or we've been hired by FedEx as a consulting team, and we're trying to understand why UPS outperforms this company so badly, and what can we change to make ourselves more like UPS, or to take advantage of any sort of differences that we might be able to change and then move into a better position compared to UPS. So this is the first step. First thing we want to look at here is let's just compare the returns just straight up, see what they look like. Now, one of the things that we might understand about return is that return, or ROIC, can be distorted a little bit by something called goodwill. So goodwill is an intangible asset added to the balance sheet when we have paid more for an acquisition than it was physically worth, tangibly worth, meaning we added up the value of all of this company's assets, and then we paid more than that value to buy the company. Now, this is typically, when we just want to abstract away from that idea, we typically just consider goodwill as the same thing as like brand, right? There's this intangible value to the company that's beyond its assets. But it could also include things like patent portfolios, It could include any kind of intangible asset that's tied to the company. So for UPS, remember they have that intangible asset that's this capitalized software. Now they've chosen to like break that apart, actually add it to the balance sheet as a separate item. But other companies might have their own proprietary software that they don't capitalize and add to the balance sheet distinctly. And so that could be included in something like goodwill and acquired intangibles. Now, the reason why this could be, this is the first thing we want to look at when we're trying to understand why FedEx and UPS might have different ROICs, is that goodwill and acquired intangibles can distort return on invested capital in a big way. And the reason is because when we add goodwill and acquired intangibles to the balance sheet, we add it to the asset side. And that means that it's going to increase our invested capital. Remember, invested capital is just our operating assets. So we add goodwill, we increase our operating assets, our invested capital gets larger. If we don't have a comparable or a commensurate addition to the income statement, then NOPLAT won't change. So the way to think about this is every other asset on the balance sheet is an operating asset, and that operating asset is going to have associated revenues and costs on the income statement. So say I buy a piece of machinery, I add that machinery to my fixed assets, and then I add the revenue the revenue that new machine generates for me, whatever it's producing. I also add the costs of maintaining and operating that machine to the income statement. And so even though my invested capital goes up because assets go up, my NOPLAT's is also going to change. It may go up or down depending on whether costs or revenue equals out. Hopefully it goes up a little, because revenue provided by the asset should outweigh costs. Otherwise we're making bad business decisions. But hopefully NOPLAT goes up and invested capital goes up, and ROIC will change accordingly. If I only add an intangible asset and there's no associated revenue or cost with that intangible asset, which is typically the case with goodwill, then all I've done is increase invested capital without changing NOPLAT, and that can cause my ROIC to shrink. And so you see these two comparisons here, right? This is Ecolab. Ecolab's a company that provides cleaning services for restaurants. So they provide soaps, and they provide dishwashers and the detergents and all the things that you need to like clean and operate a restaurant kitchen, and all kinds of other things, hospitals, etc., etc. And what we're contrasting here is their return on invested capital with goodwill over here on the right, or on the left, and the return on invested capital with goodwill over here on the right. And notice that when we don't include goodwill, meaning we don't leave goodwill in invested capital, the returns for Ecolab are actually really stellar. 33, 37, 30, 36, an average of maybe 33% return on invested capital over a 4-year period. That's extremely high. So this is how we're measuring the underlying operating performance of the firm, because this is not including any of our acquisition activity here. No goodwill or acquired intangibles from acquisitions is included in this measure of return. So this is just saying, as an operating business, Ecolab is doing great. When we look at ROIC including goodwill, that means we add all of the goodwill and acquired intangibles from any acquisitions. Notice that we cut return on invested capital for this firm by half in the first 2 years, and by 2/3 in the second 2 years. This is a measure of the aggregate value for company shareholders. And here's a way to think about it. This is now including not just the company's operating, which clearly is good, right? Their operating performance is clearly good. It's also including the decision making by the management team. Here, Ecolab has chosen to make lots of acquisitions, clearly, and make them in successive years, because they keep adding goodwill and acquired intangibles year over year. And at least from the face of it, they're vastly overpaying for the assets. Right? In other words, the only reason ROIC including goodwill is so much lower than ROIC without goodwill is because they've paid a significant premium for many acquisitions. And they may be making excellent acquisitions and paying great prices, and this is just a short-term effect on ROIC. But what we have to be concerned with here is that the management team is overpaying, overbuying, empire building, we might say, trying to make a bigger and bigger and bigger company and wasting shareholders' money, right? Invested capital. This comes from shareholder financing and wasting shareholders' money on making acquisitions that aren't adding to return for the firm. And that is going to affect share price in a negative way. Now, it just so happens that when we look at FedEx and UPS, we see no discernible difference in goodwill activity, meaning the difference between FedEx and UPS's return on invested capital is not driven by acquisition activity or overpaying in acquisition activity. But what we want to do is take that even farther. Okay, we first look at ROIC. We're going to look at it with and without goodwill. We look at it both with and without goodwill, and we see that UPS still outperforms FedEx even after accounting for intangible assets inflating invested capital. So the next thing we want to do is try to decompose return on invested capital even farther. Can we find any operating measures that operating inputs into return on invested capital that would cause UPS to be outperforming FedEx? And so what we do is we're going to decompose the ratio like this. And I'll post a little video here just showing how we did it. Those of you that are in class on Thursday before we left for spring break, we worked it out here and we saw it. This is just a little math trick that allows us to decompose return on invested capital into 3 parts. Okay. So when we're decomposing the return on invested capital measures so that we can form our ROIC tree, we use a simple math trick that I'm going to show you right here. And we start by writing out our return on invested capital. And we're just going to write our standard formula for return on invested capital here. That's NOPLAT divided by invested capital, where NOPLAT is equal to net operating profit less adjusted taxes, and invested capital is simply the sum of all the operating assets minus the operating liabilities for the firm. Now we can rewrite this just slightly by, instead of writing NOPLAT, let's write what NOPLAT actually stands for, which is net operating profit less adjusted taxes. So let's separate that out. We can write net operating profit out as EBITDA, earnings before interest, taxes, and amortization. And then we can write 1 minus the operating tax rate, and that is less adjusted taxes here. And we can divide that by invested capital. I'll rewrite this just slightly. I won't change anything here. I just want to take 1 minus the operating tax rate off to the side so that I'm left just with the fraction EBITDA, or net operating profit, divided by invested capital. Okay? And so notice that this formula is mathematically equivalent to the one above it. All I've done is rewrite NOPLAT and shift some things around. Now what I can do here, and here's the math trick, I can expand any fraction by creating 2 or more different fractions, as long as the denominator of the first fraction and the numerator of the second fraction cancel out. So I can take EBITDA and I can divide EBITDA by revenue, and then I can make a second fraction where revenue is the numerator and invested capital is the denominator. Now what you'll see is that this is mathematically equivalent, because if I do the multiplication, these 2 revenues cancel out and I'm left with exactly what I started with. Now this is valuable, and it's a valuable math trick if I can identify some kind of decomposition that tells me more about the firm, gives me more to analyze than simple ROIC above. And in fact, that's what we do. We've recognized here that if I expand using revenue, I create 2 measures. EBITDA divided by revenue, which is my operating margin, and revenue divided by invested capital, which is my capital efficiency measure. And this is this is what we look at in the slides, this decomposition. Now I can take this even further. In other words, as long as I recognize that I can create more value by continuing to expand these functions, I can do something like this. Right? So I can take my operating margin measure, and I can recognize that in a simple income statement, I have revenue minus all my costs minus depreciation gives me EBITDA. And so it's all of these pieces here in the middle that are going to be important for operating margin. And what I can do is I can expand this function a little bit more. I can say, well, I know that EBITDA for UPS is equal to revenue minus compensation and benefits minus purchase transportation minus fuel minus depreciation minus other expenses. And my ratio, EBITDA over revenue for operating margin, can be rewritten to look like this. And as long as the denominator is the same, all of these can be separated. And now you'll notice that these are how we get the rest of the branches in our tree. Compensation as a percentage of revenue, purchase transportation and fuel as a percentage of revenue, depreciation and other expenses as a percentage of revenue. These are the branches of the tree. And I can take these and I can continue to expand them even further. And you'll notice that when we do this again with labor expenses, we take compensation and benefits as a percentage of revenue, and I expand that even further using the available seat mile measures to create my labor expenses decomposition. Now, this trick is valuable, but it's only useful if I am creating things that are in turn useful. If my expansion of the formula continues to give me something to analyze. For instance, I could expand this in any other way I wanted, right? I could do this, 1 minus the operating tax rate, and then I could say EBITDA over the Cowboys win percentage times the Cowboys win percentage divided by invested capital. Now, mathematically, it's just fine. Analytically, financially, it has absolutely zero meaning, right? So we have to remember that doing this only gives us a benefit if it provides us something more interesting to look at. First is the tax rate. Second is operating margin, profit margin, operating profit margin, and the last part is capital efficiency. Right? So we decompose ROIC into these three parts, and actually we can take it even a little bit further, and we can decompose it and form it into what we call a return on invested capital tree.